I just feel like we are surrounded in this world by bullshit.
So how can you know what's real and what's not? Science versus. That's how. We answer questions like, does anti-aging skincare actually work? And what is your true personality type? And to answer these questions, we don't use opinions. We dive into the scientific studies, talk to the experts, and put it in a podcast that I know you are gonna love. Listen to Science Versus on Spotify.
This is Optimal Finance Daily. Why is taking financial risk important? Part 2 by Vicki Cook and Amy Blacklock of WomenWhoMoney.com. And I'm your host and personal finance enthusiast, Diana Merriam. Welcome back to Optimal Finance Daily, where I read to you every day of the week with permission from the authors. Today's actually a continuation from yesterday. So if you haven't done so already, I'd recommend listening to that episode first. But if you're all caught up, then let's get right back into it and hear part 2 as we continue optimizing your life. Why is taking financial risk important? Part 2 by Vicki Cook and Amy Blacklock of WomenWhoMoney.com. Number 2, educate yourself about investing. It's amazing how much information is at your fingertips when it comes to learning about investing. Yet the volume of information you can find online is also overwhelming to many new investors. Where do you start? What should you read? Who can you believe? These are all great questions. Our most important advice? Avoid getting your financial information from only one source. New investors can begin by learning some basic investing terminology and other investing concepts. Following is a list of some of the main categories of savings and investment products. Each has its own general level of risk and return. Within each category, specific products may carry more risk or provide more gain than others. There are also many alternative investments, such as real estate, precious metals, artwork, cryptocurrency, etc., you might consider when deciding where to invest your money. Some investments will be passive, while others, like real estate investing, may be more hands-on. Educate yourself in anything of interest and never invest your hard-earned cash in something you don't understand. Number 3, keep learning. Once you get more comfortable, continue reading articles, blog posts, and investing books to increase your knowledge. Debbie Sanson's The $1,000 Investor is a great place to start, even if you only have a few $100s to invest. Anxiety over investing can be eased with Julie Grandstaff's book, Save Yourself, Your Guide to Saving for Retirement and Building Financial Security. And if it all seems too complicated, J.L. Collins shares strategies you can follow in The Simple Path to Wealth. If you plan to work with a financial professional, make sure you understand how they make money. Consider working with someone who has a fee-only structure for unbiased advice. If you hire a financial coach, be sure to choose someone you're comfortable with and who has a track record of successful work with new investors. Also, check references and consider their background knowledge and experiences. Number 4, determine your financial risk tolerance. You've probably heard that the younger you are, the more risk you should take when it comes to investing. When you have a lifetime ahead of you to earn more money and deal with economic downturns, you can afford to pursue higher returns. But you also need to remember that personal finance is personal. Your money story and emotions will impact the decisions you make now and in the future, and it takes time to build your investment philosophy. Financial professionals or coaches and even robo-advisors have tools or calculators to help you determine your level of risk tolerance. You might be surprised to find out you aren't as conservative as you think, or the exact opposite. There are also tools online, such as the University of Missouri's Personal Finance Planning Investment Risk Tolerance Assessment. Vanguard and most other investment websites offer free online questionnaires too. After you answer the assessment questions, you'll get targeted feedback about your level of risk tolerance. Again, use more than one tool and compare your findings to determine the best accurate result. And number 5, take action and revisit risk. Once you've taken a deep dive into your financial situation and future financial goals, learned more about investing, or worked with someone on developing an investing plan, and figured out your risk tolerance, it's time to decide what to do about your investments and take action. Whether you decide to start investing, change asset allocation, or take more risk for a higher potential return, or stick with your current strategies for now, you're making progress towards building wealth for your future. You'll likely have more financial security by managing some level of risk, but only you can decide how much risk you'll take for potentially greater rewards. Once you determine a strategy, you'll mostly want to set it and forget it, but this doesn't mean ignoring it. You don't want to become so comfortable with your investment decisions that you fail to reconsider what risk means to you over time. Diversification of your portfolio is key. Your risk tolerance may change as you age or deal with certain life situations and get closer to or eventually retire. Managing risk to build wealth. When you decide it's time to take on more risk, you don't have to rush to change your total investment strategy. Time is a crucial factor in the magic of compounding, but making investment decisions before you're ready and understand them can backfire too. Some people embrace risk by leaving all or most of their safe investments behind. Others will sacrifice higher potential returns for more security. If a conservative approach helps you sleep better at night, investing more money for a lengthier period will build wealth too. The important thing is that you'll be making decisions about how to invest for your future, rather than being afraid to take action. By assessing your financial health, you'll know exactly where you stand with money. You won't take on a risk just because someone tells you it's important. You'll opt, or not, for investments with higher risk and greater potential returns because that's part of your financial mission and investing plan. Your mindset will shift over time from being fearful to courageously taking more risks. You'll be confident to ask questions, and you won't panic in market declines. You'll have what it takes to be a successful investor. You just listened to part 2 of the post titled, "Why is Taking Financial Risk Important?" by Vicki Cook and Amy Blacklock of WomenWhoMoney.com, and I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means F.I.R.E believes now is the time to expand the F.I.R.E flagship fund's billion-dollar real estate portfolio. You can add the F.I.R.E flagship fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the F.I.R.E flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement. I think the topic of risk tolerance can be looked at in a couple of different ways. The first is from an emotional perspective. If you see your investment portfolio go down, will that cause you to panic sell? And the second is from a more practical perspective. What is your time horizon for investing? And are you focused more on accumulation or preservation based on when you will use this money? I'm not sure it makes much sense to determine your risk tolerance from the emotional perspective. A more conservative asset allocation might alleviate some fears, but I think it would be much more efficient to address those fears with more education. If you're invested in low-fee total market index funds over long periods of time, and you understand the cyclical nature of the stock market, as well as the fact that market corrections reflect paper losses versus realized losses, you will know that you have nothing to fear. I highly recommend you read the book, Why Does the Stock Market Go Up? By Brian Feroldi to help in this regard. When you are able to mostly ignore the short-term fluctuations of the stock market, your confidence in investing skyrockets. And if you have a shorter time horizon, because you're approaching retirement and will start drawing down on your portfolio, so you don't have as much time to recover from corrections, that's a great reason to move towards a more conservative asset allocation. But the reason is based on practical need, not an emotional misunderstanding of how investing works. But that's going to do it for today. Thanks so much for being here and listening every day. And I'll see you again tomorrow for more Optimal Finance Daily, where your optimal life awaits.